Have you ever stared at the endless list of stocks and thought, how do people actually know which ones to buy? You're not alone. Most beginners feel overwhelmed, confused, and even a little scared of picking the wrong stock and losing money. But what if I told you there's a simple, step-by-step way to pick winning stocks easily? And what if one of these steps is something almost no one tells you about, yet it makes all the difference? Stick around, because by the end of this video, you'll know exactly how to pick stocks like a pro, even if you've never invested before. Number 1. Understand why you're investing. Let's start with the most important question. Why are you investing? If you don't know the goal, you'll never know if a stock is the right choice. Are you saving for retirement in 20 years? Are you hoping to buy a house in 5 years? Or are you just trying to grow your money a little faster than a savings account? For example, if you're investing for retirement, you might focus on steady, long-term stocks like Apple or Johnson & Johnson. But if you're saving for something in just a few years, you'll probably want safer, lower-risk investments, or even cash. The goal tells you everything. So before you even open an app, write down your reason for investing. Number 2. Look for companies you actually understand. Here's a funny mistake beginners make. They invest in companies they've never even heard of. If you don't understand how a company makes money, how can you possibly predict if it will keep making more? For example, imagine two companies, Netflix and a random mining company in Chile. You've probably used Netflix. You know what it does. You understand its business model. But that mining company? Not so much. Warren Buffett, one of the greatest investors of all time, calls this your circle of competence. Only invest in what you understand. So, next time you're looking at a stock, ask yourself, could I explain what this company does to a 10-year-old? If not, move on. Number 3. Find companies that are already winning. Here's a secret. You don't have to discover some hidden gem no one has ever heard of. You can just invest in companies that are already dominating their market. Think of companies like Amazon, Microsoft, and Coca-Cola. These companies have huge market shares, loyal customers, and a proven track record of making money year after year. It's like betting on a horse that has already won the race 5 times. Way safer than picking the new guy no one's heard of. One study by Standard & Poor's found that the biggest, most profitable companies tend to keep winning more often than not. So don't overthink it. Sometimes, the obvious choice is the right one. Number 4. Check if they're making real profits. This is where the numbers come in. But don't worry, you don't need to be a math genius. All you have to ask is this company actually making money? You can look at two simple things, revenue and profit. Revenue is how much money the company brings in. Profit is what's left after expenses. For example, Company A makes $100 million a year, but spends $120 million. That's bad. Company B makes $50 million, but only spends $30 million. That's good. You can find these numbers for free on websites like Yahoo Finance or Google Finance. And if you see a company losing money year after year, it's probably not a good pick. Number 5. Look for a competitive advantage. What makes this company special? Does it have something other companies can't easily copy? This is called a moat. And it's another idea from Warren Buffett. For example, Google has a moat because everyone uses its search engine and advertisers can't avoid it. Apple has a moat because of its loyal customer base and ecosystem of products. If a company can't be easily replaced by competitors, it's more likely to keep making money. Think of it like this. If someone can just open a store next door and steal all their customers, that's a red flag. Number 6. See if the stock is a good deal. Even a great company can be a bad investment if you overpay for it. Imagine buying a house for $1 million when every house on the block sells for $300,000. Not smart. Stocks work the same way. You can use something called the P/E ratio, price divided by earnings. If a company earns $5 per share and sells for $50 per share, that's a P/E ratio of 10. Lower P/E ratios can mean the stock is cheaper compared to earnings. But be careful. Sometimes low P/E means the company is struggling. Compare the P/E ratio to other companies in the same industry to see if it's fair. Number 7. Watch out for too much debt. Debt can be dangerous, especially in bad economic times. A company that owes too much money might not survive a downturn. For example, during the 2008 financial crisis, companies with high debt struggled the most. You can check a company's debt-to-equity ratio. how much debt they have compared to what they actually own. Lower is better if you see a company drowning in debt, think twice. Number 8. Pay attention to trends. Sometimes, even good companies get caught in bad trends. For example, Blockbuster was once a great company, but it didn't keep up with the shift to streaming. Meanwhile, Netflix grew because it was riding the streaming wave. So ask yourself, is this company part of a growing industry? Or is it stuck in the past? One way to check is to read about trends in technology, healthcare, energy, or other sectors. Companies that ride growing trends have a better chance of success. Number 9. Don't forget the dividends. Some companies pay you just for owning their stock. These are called dividends. For example, Coca-Cola has paid dividends every year for decades. If you're looking for steady income, dividend stocks can be a smart choice. You can find out how much a company pays by checking its dividend yield, the annual dividend divided by the stock price. Dividends are like a little bonus on top of your investment. Number 10. Keep it simple and diversify. Here's a little reality check. You don't need to pick just one perfect stock. In fact, it's risky to put all your money into one company. Instead, pick several good stocks across different industries. Or, even easier, you can buy something called an index fund, which is just a collection of hundreds of stocks in one. For example, the S&P 500 index fund owns pieces of 500 big USA companies. That way, even if one stock goes down, the others can balance it out. Number 11. Be patient. Here's the hard part. Waiting. The stock market goes up and down, but over time it tends to grow. For example, if you invested $1,000 in the S&P 500 in 1980, by 2020 it would be worth over $9,000, even with crashes in between. So don't panic when the market dips. Winning stocks need time to win. Number 12. Check the management team. A company is only as good as the people running it. Strong, visionary leadership can make all the difference in a company's success. For example, Steve Jobs at Apple turned the company into a global powerhouse with his innovation and drive. Before investing, look at who's in charge and what their track record looks like. If the CEO and team have a history of growing businesses and making smart decisions, that's a good sign. On the other hand, if they're known for scandals or mismanagement, think twice. Number 13. Look at customer loyalty. A company with loyal customers is much more likely to thrive over time. For example, people who buy Apple products often stick with Apple for years because they love the ecosystem. You can tell a company has loyal customers if it has a strong brand and repeat business. Check reviews, look at customer surveys, and see if customers keep coming back. A loyal customer base is like a hidden safety net for a company. Number 14. Keep an eye on innovation. Even successful companies need to keep innovating to stay ahead. Look for businesses that are always improving, launching new products, or finding better ways to serve customers. For example, Amazon started as a bookseller and turned into a global leader in cloud computing and e-commerce. If a company is stuck doing the same thing without improving, competitors might overtake it. Innovation is a sign that a company is planning for the future. Number 15. See how they handle tough times. Every business goes through challenges, but how they handle those moments tells you a lot. For example, during the pandemic, some restaurants pivoted quickly to delivery and takeout, while others failed to adapt. Check a company's history to see how it responded during recessions, crises, or big market shifts. Resilient companies with strong planning tend to bounce back better and grow even more. Number 16. Watch insider activity. Here's an interesting tip. Pay attention to what the company's own executives are doing. If insiders like CEOs or directors are buying shares in their own company, it usually means they're confident about the future. On the other hand, if they're all selling large amounts of stock, that could be a warning sign. You can find this information online under Insider Trading Activity for each company. It's like getting a little peek at what the people who know the business best are thinking. Number 17. Read the news. Stocks don't move in a vacuum. They react to news, politics, and global events. For example, when new environmental laws pass, companies making clean energy tend to benefit. On the other hand, companies in industries like tobacco or oil might struggle when regulations tighten. Stay updated on current events and think about how they could impact the companies you're interested in. Being informed can help you avoid nasty surprises and spot opportunities early. Number 18. Think long-term. Too many beginners focus on short-term price swings and forget about the big picture. Winning stocks often take years to show their true value. For example, if you bought Amazon stock in the early 2000s, you'd have seen years of ups and downs before it skyrocketed. If you believe in a company's future, be willing to hold on through the bumps. Patience is often the most important skill an investor can have. Number 19. Learn from your mistakes. Even the best investors pick a few losers. The key is to learn from what went wrong and make smarter choices next time. Keep a notebook of your investments, why you picked them, and how they performed. Over time, you'll see patterns and improve your decision-making. Remember, every great investor started as a beginner, just like you. Now you have everything you need to start picking winning stocks with confidence. It's not magic, and it's not luck. It's about following these steps, doing your homework, and staying patient. So tell me, which of these tips did you find most helpful? And do you already have a stock in mind that you'd like to invest in? Let me know in the comments. I can't wait to see what you're thinking.